Hello, everyone, and welcome to another episode of PS Perspectives. I'm Sam Nussbaum, Product Specialist here at DoubleLine, and this is my colleague Corey Claremont, Product Specialist. We specialize on our asset allocation fixed income products, and we thought we'd take today's opportunity to walk you through what's been quite a volatile year across fixed income markets that have seen some significant upheaval so far this year. So we wanted to show some performance across various sectors of the market, what's driving those returns in fixed income, and the opportunities that we see as a result. So, Corey, maybe you can kick us off talking about returns across various sectors of the market.
Yeah, of course. Thanks, Sam. And I think you put it perfectly in the intro. The bond market has been volatile and in a state of upheaval at certain points. And so looking at the screen here, what you can see is the year-to-date fixed income performance. And all the way on the left-hand side there, you have the ag, which is down about 16%. Its worst start ever to a year going back to 1976 when the index was launched. And to the right of that, you can see the three main components being treasuries, agency mortgage-backed securities, as well as investment-grade corporates. So the three main components. And treasuries and agencies, they've been, the drawdown's largely been due to that of duration, right? They're longer duration assets. And so that interest rate move has definitely hurt their performance, down about 15%. Whereas investment-grade corporates, their duration is right around 7 years. So duration has hurt them as well. But you have the other component being corporate credit spreads, which have widened on a year-to-date basis. So when you put the two together, you're down about 20%, which is the worst of the three components within the ag.
Yeah, and we typically refer to these parts of fixed income as traditional sectors. Maybe you can take us through some non-traditional sectors as well in terms of performance.
Yeah, of course. In rounding out kind of corporate credit, right, in the below investment grade space, which encompasses both high yield corporate debt as well as bank loans. High yield, its duration is right around 4 years. So moves within the Treasury curve have hurt high yield from a performance perspective. Also, spread widening has been a little bit more substantial in terms of an absolute level versus its investment grade counterparts. Then moving over to bank loans, I mean, look at bank loans. They're barely down on the year, basically flat, and that's due because they have very minimal interest rate sensitivity. But moving outside of the U.S., looking at global sovereigns as well as emerging market debt, those are both longer duration assets, and obviously on the emerging market corporate side, credit spreads have widened, kind of akin to what we've seen in terms of below investment grade high yield corporates. And then the gray bars on the right-hand side, that's going to be securitized credit, and that's down anywhere from a few percent to call it mid-teens. And the primary reason that it's outperforming its investment grade corporate counterparts is because it has less interest rate sensitivity. And so I think a common theme of performance year to date has been the moves within the US Treasury yield curve, right? And that affecting the duration component and ultimately returns. So can you kind of walk us through where Treasury yields are today?
Yeah, sure, certainly. And as you mentioned, the Treasury yield curve has seen a significant repricing. And what we're showing you on this slide is 4 tenors of the Treasury yield curve, starting with the 2-year on the short end. The short end of the curve is most sensitive to Fed policy and monetary policy, specifically the Fed funds rate. And what we've incurred this year is the fastest Fed tightening cycle really in history. The Fed's raised the target Fed funds rate by 375 basis points this year. That's dragged the 2-year up in yield by about 385 basis points this year. So substantial repricing there. Moving out the curve, you have the 5-year yield that's up about 400 basis points so far this year. And then you have the 10-year note and the 30-year bond, which comprise the long end of the curve. And the long end of the Treasury yield curve, in our opinion, is driven more so by expectations of longer run growth and inflation. Of course, the inflation side of things is what's more pertinent this year, as you have a Fed that's raising rates and tightening policy in order to get a handle on inflation that's running by some measures at about 40-year highs. And so that's dragged the 10-year up in yield by about 260 basis points and the 30-year bond yield up by about 240 basis points. But again, duration is only one part of the story, as you pointed out. And spreads have widened as well. So maybe you can show us where spreads are sitting across corporate credit today.
Yeah, of course. And so up on the screen here, you can see 2 panels. On the top panel, it's investment grade corporate credit spreads here in the United States. Bottom panel is below investment grade, and that dashed line is on an index level. So what you can see in the common theme is that spreads have widened year to date, and that's largely what we've seen within securitized credit and emerging markets as well. And so looking at investment grade corporate bonds, they're at a level of around 150 basis points over US Treasuries. And so the last 2 times we saw this was in the fourth quarter of 2018, as well as COVID of 2020. So those are definitely periods of market stress, periods of market volatility. And then looking at below investment grade, we're sitting at a level right now about 500 basis points over treasuries on an index level. It did tick 600 earlier this summer, but one of our colleagues, Colin Callahan, put out an episode 2 weeks ago on the high yield market. And in short, when high yield spreads get to about 500 basis points over treasuries, as a long-term investor, it's usually a good time to start thinking about allocating capital to that sector. And so when you put widening spreads on a year-to-date basis with rising treasury rates, how are investors being compensated for owning fixed income today?
Yeah, well, they're being compensated by higher all-in yields, as you alluded to. So on this slide, we've delineated the market between, again, these traditional sectors of fixed income, so the ag and then its subcomponents, treasuries, agency mortgages, and investment-grade corporates. Those are all yielding today in the mid-single digits. And by way of comparison, about a 5% yield to maturity on the ag is right about where high-yield corporate bonds were yielding at the beginning of this year. So quite a substantial repricing there. And then in the more non-traditional sectors of the market, in terms of the strategies that Corey and I specialize in here at DoubleLine, the ones that have a sufficiently broad opportunity set to encompass these non-traditional sectors of the market, that's where we really see and hear from our investment teams that these are some of the most compelling attractive opportunities that they've seen really at any point in the past decade, outside again of periods of brief stress within markets. So you put that all together, it's quite an attractive environment. Spreads have widened, yields are up, and investors are now being compensated in terms of yield. And as fixed income investors, the good news is that we know that starting yield has a strong relationship with forward return.
Yeah, and let's not forget, while there are potential opportunities today, it's been a pretty painful ride to get there, right? And we started off with that first slide looking at year-to-date performance. And again, that was really driven by duration as well as credit spreads, which have widened and rates have risen. And so that leaves us with higher all-in yields and an attractive opportunity. And that's definitely something that we're thinking here at DoubleLine. So thank you for joining. That concludes the third episode of PS Perspectives, and take care.